and welcome to yet another edition of What the World Wants from India. Ahead of the budget and the general elections, we speak with leading global market masters about how they are approaching India ahead of these two crucial events. Of course, we will also try to glean the global context in which Indian economy and Indian earnings are situated. Today we speak with three such masters. First up is Robert Buckland of Citi. In a bit, we are going to be joined by Brian Jacobson of Wells Fargo, and then Jim O'Neill, the man who coined the term BRICS. But first up, by far the man who steers perhaps the largest money bags, Robert Buckland, Citi's Chief Global Equity Strategist. Thank you very much, Robert, for joining us today. First up, your view on global equities in 2019. Will emerging markets outperform developed markets this year?
Yeah, as a team, we here at Citi expect global equities to be up 14% this year. The big rally we've seen so far in the year has already eaten into 5 or 6% of that. So, in general, we think this bull market is stalling but not yet finished. As far as emerging markets versus developed markets are concerned, maybe one point of interest for your viewers will be the fact that we raised emerging markets to an overweight at the start of this year, having been pretty cautious on them last year. So we're positive on global equities, but we're now more positive on emerging market equities.
Okay, that's good to hear. You've raised your weightage on emerging markets to overweight. What about India? What will your rating be of Indian equities?
I think I said last year that India has always looked kind of expensive relative to the other emerging market stock markets that we can see at the moment. So at the moment, we're more cautious on India relative to emerging markets. But remember, within emerging markets, we're quite positive. So we might be underweight India in an emerging market portfolio, but that doesn't mean that we're particularly negative because we're positive on all emerging markets.
But what makes you cautious on India? Is it the upcoming elections, possibility of fiscal profligacy before the elections?
Remember, I'm no great expert on your domestic stock market. Okay. It's my job to either engage international investors or not in your market. Okay. But from outside, I would say that India has always looked a little bit expensive to us. Propped up by strong domestic money inflows, but international investors are generally put off or can be put off by the high valuations. To give you some sense of that, your market trades on 18 times 2019 earnings compared to the US now trading on around 13 or 14 times. So nothing against India, it just looks a bit expensive to us.
Okay, well, let me persist a bit. You know, as a foreign investor, theoretically, what would your reaction be if there is a large fiscal deficit? Would that be a worry ahead of, the elections?
Let me put it like this. Again, it's my job to put India in a global context. Political and fiscal concerns, everyone's got those right now. So I wouldn't zero in too much on that. That's not the main reason why we're less keen on India than other emerging markets. Really, it's much more of a valuation-driven thing.
All right. I can take your point. I won't persist on this micro. Let me zoom back to the global economy and markets. The big theme this year has been the global slowdown. I mean, the World Bank and the IMF have downgraded global economy because of trade wars. In your assessment, is it just a slowdown or is it as bad as the recession? And would other markets be shock absorbed from the slowdown that we are seeing in China?
I mean, the title of the report I wrote at the start of this year was Slowdown, Not Recession, and I think that's a great way of summing up how we see things. You've got to remember, markets aren't going to sit around and wait for economists to downgrade GDP forecasts. You're clearly starting to see those coming through, as you're saying, but that's why the markets moved sharply lower in Q4 of last year. To put it into context, we reckon we started this year with the stock market discounting 4 or 5% off global earnings per share in 2019. To give you some perspective on that, Analysts, if you aggregated all of their company forecasts in 2019, started the year off forecasting +7 or +8. So we would argue that the market was already saying at the start of this year that analysts needed to downgrade by 10 or 11%. There was a lot of bad news in the price. That was our main argument at the start of this year.
Which way you think crude will head in 2019? Considering that you're speaking about a slowing economy, shouldn't that keep crude prices subdued?
Obviously, there's always a bit of a trade-off. Some people want, some markets want oil to go up. Some markets, like you guys, want oil to go down.
Yes.
We think a combination of weakening demand and a big burst of supply, particularly from shale in the US, has contributed significantly to the downdraft in the oil price so far this year and, of course, towards the end of last year. We think the oil price should stabilise as we look ahead, particularly because, again, I think even oil is starting to price in something a little bit worse, perhaps, than just a global economic slowdown. It was starting to think about pricing in a global recession. We don't think that's going to happen. We wouldn't be predicting 2 rate hikes from the Fed if we thought that was going to happen.
OK, it's not rate hikes, but I would like your view on the Fed's contracting of its balance sheet. Do you see that continuing? And if it does, what ramifications can that liquidity crunch have on global equities and emerging market equities?
Well, remember, the Fed has been contracting its balance sheet for some time now. Probably more important are what other central banks are going to do, particularly the ECB. But we are generally expecting QE policies, which have been the really profound new thing in this economic cycle and market cycle relative to the cycles that I've experienced in my 30 years in this business. We are expecting central banks to unwind that as we move ahead. But they'll do it gradually. And if they see big market volatility as a result of them doing the unwind of quantitative easing, they'll back off a bit. And I suspect that's what the markets are a little bit thinking about at the moment as they've rallied quite hard. But yes, QE will unwind. It naturally unwinds, remember, as portfolios of bonds turn into cash on central bank balance sheets. So yes, we do expect that to continue to unwind. Again, consistent with our view that the world economy is doing OK. It's slowing down, but it's still going to do OK in 2019 into 2020.
OK. Well, on that cautiously optimistic note, or caution and optimism, Robert Buckland, thank you very much for joining us.
OK, thank you.
OK. Well, so the key takeaway is that it's a slowing economy, global economy, not a recession. And more importantly, we shouldn't worry so much about a liquidity crunch, because if it was destabilizing, then the global central banks, notably the Fed, would slow down on its balance sheet reduction. That's a positive note. Well, that was Citi's global strategist, Robert Buckland. We take a break, and after that, we have another senior investment strategist, the one from Wells Fargo, Brian Jacobson, will be joining us. We're back in a minute.